In the last few days, Iraq's dollar price on the street didn't drift, it jumped. Reports tracked the local quote moving from 138,000 dinars per $100 to 148,000 dinars per $100 in about 5 days, a swing that would be treated as a major event in most managed currency systems. At the very same time, the official anchor stayed pinned at 1,300 dinars per dollar as if the parallel market was happening on another planet. Not months, not weeks, in days. And that gap between the official price and the street reality is the kind of stress signal that breaks normal expectations. Because when a country has two prices for the same dollar, you are not looking at a normal exchange rate story. You're looking at plumbing. You're looking at access. You're looking at who can settle a transaction, who can't. And what happens when the rules change faster than the economy can adapt. They said reforms would close the spread. They said platforms would make it clean. They said the new compliance stack would stabilize everything. Yet the tape is printing something else. Here's the part most people miss. The parallel rate is not just a black market rate. It is a live referendum on trust and liquidity, updated transaction by transaction. When it widens, it is telling you that dollars are available to some people at one price and unavailable to others unless they pay a premium. The premium is the market's way of pricing friction, and friction is where currencies break. Welcome to Parallel Ledger, where we decode currency stress before it becomes a headline. If you're here for analysis, the kind your wise uncle would give you after watching the market for 20 years, you're in the right place. Tap subscribe if you want more of these breakdowns, and drop a comment telling me where you're watching from. Because currency stories always look different depending on what you pay for bread, fuel, rent, and school fees in your city. Now let's reconstruct what happened like an investigator, not a rumor mill. Iraq's official exchange rate for government accounting is set at 1,300 dinars per dollar for the 2026 budget framework. That number matters because it's the ruler used for salaries, contracts, and the state's own math. But markets trade on settlement, not on spreadsheets. In late January into early February 2026, the parallel market began re-widening again with Widens. Circulated quotes around 1,560 dinars per dollar in local dealing circles. In parallel, the street quote expressed in per $100 language moved sharply from about 138,000 dinars per $100 to about 148,000 dinars per $100 in roughly 5 days. A 1,460 parallel print against a 1,300 official anchor is roughly a 20% gap. 20% is a wedge large enough to change behavior. It changes how importers quote prices. It changes how people hold cash. It changes how fast a paycheck loses purchasing power. It changes incentives for anyone who can touch dollars at the official price. And when the incentive is that big, the system doesn't simply absorb it. The system reorganizes around it. So what actually caused the widening? Start with what the official rate represents. It's not a magical market clearing price. It is a policy price. And policy prices only work when the channel that delivers them works smoothly. Iraq's dollar access has been pushed through an evolving pipeline. Commercial banks, trade, documentation, electronic verification, and external settlement rules meant to reduce illicit flows and improve transparency. That direction is normal for a financial system that wants global integration. But in the short run, a more controlled pipe can behave like a narrower pipe. If you hear people talk about platforms and compliance, don't translate that into bureaucracy and move on. Translate it into time. Translate it into approvals. Translate it into whether an importer can pay a supplier this week or next month. Translate it into whether a small business can get dollars through a bank or whether they have to go to the street and pay a premium to keep inventory moving. One reason this matters in Iraq is that imports are not a niche corner of the economy. Imports are daily life. Food inputs, machinery, electronics, auto parts, pharmaceuticals, construction materials, packaging, even many consumer staples. When official dollar throughput slows, those costs don't wait politely. They reappear as higher prices, thinner shelves, or delayed projects. And that's how a spread becomes an inflation story without a single official rate change. This is where the central mystery forms. If the official rate is stable, why does the market behave as if dollars are scarce? If the system is more compliant, why does the spread sometimes widen instead of narrowing? If reforms are meant to bring order, why does the street price suddenly lurch? To answer that, you have to see the hidden pattern. The hidden pattern is that managed exchange rates fail in predictable ways, and the earliest signal is almost always the spread. The spread widens first, then economic behavior changes, then policy reacts, and only later does the official narrative update. It's not unique to Iraq. It's a recurring playbook across decades and across regions. In 2015 and 2016, when oil prices were under heavy pressure, oil-dependent governments faced a familiar squeeze. Revenue in dollars dropped while domestic obligations and local currency kept rising. Many countries tried to hold official pegs or bands steady to project stability, but the parallel rate often told the truth first. It widened, not because the official number was wrong, but because access to dollars became rationed. In 2020, Iraq had its own pivotal moment. The government devalued the dinar in late 2020, shifting the official rate to around 1,160 per dollar after years near 1,182. That wasn't a meme. It was a macro adjustment to a revenue and spending reality. The key lesson is the same. Pressure accumulates off-screen, the spread flashes on, and then policy eventually chooses a path. In 2022 and 2023, Iraq experienced a vivid version of the modern compliance era. As settlement controls tightened and dollar transactions were scrutinized more aggressively, the parallel market rate weakened even as policy sought to keep a line. Then, in early 2023, the official rate was moved again, with the policy anchor brought to 3,300. That sequence matters because it shows how the system can shift the official ruler, yet the spread can still appear if the delivery mechanism is strained. Now in 2026, the pattern is flashing again. Official stability on paper, widening spread in practice. So who is moving, and how can you tell? Institutional movement in currency markets is rarely announced with fireworks. It shows up as process changes, platform shifts, and rule updates. It shows up in who gets approved, how fast, and under what documentation standards. It shows up in the timing of policy statements versus the timing of market moves. And it shows up in the priorities of external stakeholders who care less about local narratives and more about cross-border settlement integrity. The Central Bank of Iraq sits in the middle of this. It provides the official anchor and manages the channels through which dollars flow into the banking system. Commercial banks are the arteries, importers and traders are the end users. Custom systems, invoicing standards, and verification platforms are the checkpoints. And external counterparts, including correspondent relationships in the global dollar system, shape what Iraqi banks can clear, what gets delayed, and what gets rejected. Here's a practical way to see institutional positioning. When the system shifts from broad access toward more controlled access, the first movers are the institutions that can navigate paperwork, compliance checks, and bank relationships. They still get dollars, though sometimes slower and with higher internal costs. The second group, usually smaller businesses and informal networks, suddenly faces delays, rejections, or unpredictable timelines. They move to the parallel market. The spread widens, not because the country ran out of dollars overnight, but because the distribution channel stopped behaving like a smooth conveyor belt. To make this even clearer, think about the chain of a single import transaction. A trader agrees to pay a supplier in dollars. To do that through the formal system, the trader needs a bank willing to intermediate documents that match the purpose of the payment and a customs record that confirms the goods actually exist. If any link is weak, the payment is delayed or rejected. And when Iraq digitizes or tightens those links, the system can become safer but also slower, especially for smaller firms that don't have dedicated compliance teams. That is why customs automation and invoice verification matter more than most people realize. When a customs platform changes how invoices are registered, or when banks are told to require more detailed documentation, the friction shows up as a dollar premium outside the system. It doesn't take a nationwide panic. It only takes enough delayed settlements to push repeat buyers into the street market. Now, zoom out one more level and look at incentives. If the official rate is 1,300 and the street rate is closer to 1,480 or even 1,560, anyone who can access the official channel is effectively holding a discounted dollar. That creates demand not just for dollars, but for access. Access becomes a commodity. Relationships matter more. Paperwork matters more. Timing matters more. The market begins to price permission as much as it prices currency. And here's the historical reason that matters. In 2016, Egypt lived with a wide gap between official and street rates until the pressure became impossible to manage. And the end result was a policy reset that rapidly changed the official price level. In Nigeria, repeated attempts to maintain multiple windows created persistent distortions that kept the parallel market relevant even when official policy tried to simplify. Different countries, same mechanism. When gaps remain, they change economic behavior long before they change an official announcement. That doesn't mean Iraq is destined to repeat any single country's outcome. It means the mechanics are universal. The longer a widespread persists, the more it becomes embedded in contracts, pricing habits, and expectations. And once expectations adapt, compressing the spread requires more than announcements. It requires throughput. It requires trust. It requires a channel that works for commerce, not just for large, well-connected players. So the next time you see the official rate quoted with confidence, ask a second question. How long does it take to actually get dollars at that price? In currency systems, price without access is theater, and spreads expose that in real trade. This is not a moral story. It is a mechanical story. and the dislocation is the giveaway. The dislocation is simple. The official exchange rate tells you one story, while real transaction prices tell you another. One market says the dinar is stable at 1,300 per dollar. Another market prices dollars as if they are scarce. These two realities cannot coexist indefinitely without consequences because they create arbitrage pressure. Arbitrage is just a fancy word for the system trying to equalize. If someone can buy dollars at 1,300 and sell them at 1,460, the profit is obvious. And when that profit is large, it attracts volume. It attracts creativity. It attracts networks that specialize in moving value across channels. It attracts fake invoicing games, over-invoicing, under-invoicing, split shipments, and every trick that turns a paperwork system into a profit engine. The wider the spread, the stronger the incentive. And that creates a second contradiction. The very reforms meant to reduce leakage can temporarily increase the value of leakage because they restrict the official pipe, while the parallel price floats higher. The more valuable the arbitrage becomes, the more enforcement is demanded. The more enforcement arrives, the more legitimate users feel the slowdown. That's how a system can tighten itself into a wider spread, at least for a time. They get used. In early 2023, a striking data point circulated in major reporting. Cross-border Visa and MasterCard transactions tied to Iraq reportedly surged from about $50 million to about $1.5 billion per month. Put that into perspective. That is a move from small to moderate activity into a scale that forces questions about who is using the rails and why. When a spread exists, any rail that can convert local currency to external dollars becomes attractive. The market does not need slogans. It only needs incentives and a pathway. So when you see a spread widen in 2026, you should immediately ask, what rails are being tightened, what rails are being exploited, and what rails are being rebuilt? Now let's stack the numbers, because numbers keep this grounded. Official budget anchor, 300 dinars per dollar. Parallel quote that circulated widely, around 1,560 dinars per dollar. Street quote in per $100 language. 148,000 dinars per $100, which implies about 1,480 per dollar, after being around 138,000 dinars per $100 just days earlier, implying about 1,280 per dollar. These are not identical numbers because different markets quote differently on different days, in different cities, and with different transaction sizes. But the direction is consistent. The market has priced dollars higher than the official anchor, and at times the move has been fast. That speed matters. Managed systems can tolerate mild spreads. They struggle when the spread accelerates, because acceleration changes expectations. When people think the dinar will be weaker tomorrow, they demand dollars today. When importers think replacement costs will rise, they raise prices now. When banks expect tighter checks tomorrow, they become conservative today. A widening spread is not just a price, it is a catalyst. Now bring in the external lens, because it explains why the pipeline can feel tight, even when dollars exist. Global dollar settlement is not a free-for-all. It is a permissioned system governed by correspondent relationships, compliance standards, and the risk tolerance of large institutions that can say no with a single policy memo. When a country is under increased scrutiny, banks overcomply. They slow down. They ask for more documents. They reject payments that look even slightly irregular. This is not personal, it is risk management. But for the local economy, it feels like someone turned down the water pressure while insisting the price of water is unchanged. That's why international institutions pay attention to the spread. In May 2025, the IMF explicitly discussed the importance of reducing the spread between the official and parallel market exchange rates in Iraq, treating it as a key objective and a signal of how well the framework is functioning. When the IMF mentions the spread, it is acknowledging that the spread is a macro indicator. It reflects distortions, pressures, and the credibility of the exchange rate framework. So if the spread is widening again, it is not a gossip story. It is a signal that something in the system is not clearing smoothly. Now, let's explain the mechanism in a way that makes the complexity simple without flattening it. Imagine a city where water is priced at a fixed rate, but access to water depends on permits. On paper, the water price is stable, but if permits get delayed, or if certain neighborhoods have their access restricted, the price of water delivered by private trucks rises. People start paying the truck price because they need water now. The official price becomes less relevant to daily life, not because the official price changed, but because access changed. That's the exchange rate spread in human terms. The water is dollars. The permits are compliance checks, trade documents, invoice verification, customs matching, and bank approvals. The private truck price is the parallel rate. And when the gap between the official price and the truck price gets large, the city faces two problems at once. Social pressure, because essentials cost more, and systemic pressure because the permit system gets gamed. How does it get executed in markets? It often starts with a bottleneck, a new platform requirement, a documentation rule, a customs verification step that requires exact matches, a bank becoming more cautious after a compliance review, a category of payments being slowed because it has been abused in the past. The bottleneck creates delays. Delays create urgency. Urgency creates premiums. Premiums widen the spread. Widening spreads create arbitrage. Arbitrage attracts volume. Volume attracts enforcement. Enforcement tightens the bottleneck, and the cycle can feed on itself. This is why the spread can spike quickly, even if the central bank's stated rate is unchanged. Now, connect this to the bigger economic picture. Iraq is an oil exporter. Oil revenue arrives primarily in dollars. The public sector is large, and domestic spending occurs in dinars. That setup means the system depends on smooth conversion and distribution of dollar inflows into the local economy. When that distribution becomes constrained, even temporarily, stress shows up immediately in the spread. At the same time, Iraq's economy is deeply trade-linked for many goods. If importers cannot reliably access dollars through official channels, they either delay imports or pay the parallel premium. Delayed imports can create shortages. Parallel premiums raise local prices. Either way, households feel it. This is why a widening spread is not an abstract chart. It is a living cost. So what does all of this mean going forward without turning this into a prediction show? Historically, when spreads widen and persist, one of three broad paths tends to follow. The first path is tightening plus targeted supply. Authorities tighten enforcement and compliance while also increasing the throughput of legitimate dollar supply, trying to compress the spread without losing control. In this path, you often see clearer documentation rules, faster processing for compliant importers, and a push to route more trade through formal banking channels. The spread may remain volatile, but it tends to compress when confidence in access returns. The second path is a temporary spike followed by administrative relief. If the widening was caused by a specific bottleneck, authorities may adjust the bottleneck, speed approvals, widen eligible categories, or clarify platform rules, and the spread can narrow relatively quickly. This path is common when a new system is rolled out and then calibrated after real-world friction appears. The third path is a credibility reset. If the spread remains wide and expectations shift, the market can begin to treat the official anchor as less informative, forcing policy to choose between defending the anchor with stricter rationing or allowing a new equilibrium to emerge. This is the path authorities try to avoid because it can become self-reinforcing. Which path emerges depends on observable indicators, not on wishes. So what are the indicators? Watch the spread itself, not just the level, but the pace. A slow, narrowing spread suggests easing frictions. A fast, widening spread suggests intensifying rationing or demand. Watch trade financing flow. If banks are clearing import payments smoothly, pressure should ease. If importers complain of delays, premiums tend to persist. Watch retail price behavior. If essential goods start repricing rapidly, it indicates the parallel rate is leaking into real prices. Watch official communication and operational changes. When authorities emphasize platforms, documentation, and settlement integrity, it usually means the system is actively being adjusted. And watch payment rails. When non-traditional rails suddenly handle unusually large volumes, it's often a sign the market is searching for ways around bottlenecks. Now here's the divide, and it's the most important part. Most people look at an exchange rate and think it's just a number, but the spread is not a number. It is a social hierarchy written in digits. It shows you who has access to the official channel and who does not. It shows you whether a small business can import at a predictable cost or has to pay a premium. It shows you whether the system is delivering stability broadly or delivering stability selectively. It's not about being smart. It's about paying attention to the right signal. Institutions move first because they live inside the plumbing. They see approvals slow, they see compliance tighten, they see volumes shift. They adjust before the public conversation catches up. Retail reacts last because retail only sees the result, usually at the checkout counter. So when the parallel rate widens against a fixed official anchor, treat it like a warning light. Not a guarantee of catastrophe and not a reason for panic. A warning light that says the settlement system is under strain, incentives are distorting behavior, and policy responses are about to matter. Because the most dangerous moment in a managed currency system is the moment everyone pretends the spread is normal. This is parallel ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether markets move. Markets always move. The real question is whether you understood the signal while it was still just a spread on a dealer's screen.